Hi, I want to talk about the recent events regarding interest rate. Uh, there is a lot of chatter on the internet. I was watching Greg Hunter, USA Watchdog, and also Peter Schiff, and they all saying that cutting the interest rate will cause a lot of other problems that the Fed is not looking at. Well, I think that this time when they cut the interest rate, uh, the market is going to wake up and see that they're really losing money on the long-term bonds, like 30 years. And if they take the inflation into account, then they're actually losing significant money. And also because the interest rate yield curve has inverted, that means that the short-term loans or bonds to the U.S. government is paying more interest than much longer bonds like 30 years. I think the overnight rate is paying better than 10 years, something like that. Just like for one day, you loan them money, and then you make more money. But uh, with all the money that the U.S. government has dished out and printed out and sold as bonds, and uh, the inflation hasn't kicked in, as if the inflation has died. Well, there is a real good reasons for that. Is because there is a lot of cheap labor around the world, and many products, many goods, even agricultural goods, they're really nothing but labor that has been prettified into this little package and been sold off. So the reason that the inflation hasn't kicked in is because there is a lot of deflation, and these products, they come in, and the society has gotten used to buying this item for $1 or for $10, and then there is that force of resistance to increase the price, even though the value of the dollar has been sliding. Well, they are going on another money printing binge, and when they make the interest rate lower, then many corporations, they can continue to borrow at a cheap rate and roll over their old debt, which was borrowed at a more valuable dollar, into this new dollar that's more depreciated. But they win out, and then they can play all these financial games. And but I think this time, when they dish out a lot of cash to banks and corporations, and they issue bonds, what will happen is that two things will happen. One is that there will be some inflation. It might not be this new inflation would kind of supersede the deflationary trend that I mentioned before. But then also that at some point, even if the managers of these bonds, even if they're kind of dead, they kind of wake up one day and they say, "Hey, I'm losing a lot of money in these bonds, and why am I holding them for 30 years? So let me just cash some of them out." This is how the avalanches start. They start with like a few isolated places where the snow has just become too much. They will fall off, and then the more of the mass of the snow that's overhanging, it kind of seeps out or leaks out, and then it gathers momentum, and then the whole thing comes down. Well, then this can happen with bonds too. And I know that the Fed is holding $4 trillion worth of bad debt that they have bought, and we keep hearing on the internet, hey, that printed 21 trillion, and we have all these derivatives, but there's a lot of money that's being siloed all over the places in banks, with corporations, and this money at some point will look for a better yield, a better way of making money, instead of the very risky environment that's in the stock market or in the bond market even. So it will look anywhere, it will kind of seep into shorter term bonds initially. That would be a huge disaster right then, and then also it will seep in precious metals. And while I was watching USA Watchdog, he was talking about that they just passed a law to allow, I don't know, 400,000, 40,000, a lot of skilled labor to come in from India. And India is just one country, but I mean, if you were a corporation or a company, and you were going to hire engineers or a software developer, and there was this Indian guy, you could hire him for cheaper, and he's got better smarts and more dedicated to his job than the American. I would go and hire the Indian, or even outsource the whole project to some Indian company for a set fee. But that might be very cheap in comparison to bringing these people in. And but that's where the deflation is, and also that for the money you would get a much better return on investment to go to these foreigners or foreign countries than to hire Americans. But then what might happen is that what the title of this video is, the hard slap of the hidden hand of the market, which means that at some point there will be a snapback, and at some point the holders of debt or capital, they'll wake up and say, hey, I could do a lot more with this money or these bonds than investing it with the stupid American government. Well, the agency or the corporation that buys or is always thirsty on a lot of these bonds or the money is the U.S. government itself, doing all these stupid things, going all kinds of places, have bases across the globe, and shelling out cash. Well, a lot of that money is money that's completely gone. After a year, the military expenditures, there is no return on investment. There's 100% loss, and then you have to pay the interest on it too. Well, then if a private bank could look at this, say, hey, I'm loaning these idiots $1.6 trillion, and a lot of that money is just going to sit on my books for 30, 40 years, or if there is ever any return on investment, then they could say, I could do a lot more with this. I know that if I took even a minute fraction of all this capital and invested in, I don't know, Africa, or invested in Sudan or Egypt, well, my returns would be return on investment might be 80% or 200% comparison to 2% that the U.S. government might return on a 10-year note. So this is really the equalization point. This is where the hidden hand of the market comes in. Well, when I was going to college, I was very much fond of studying engineering and fluid mechanics. And one of the courses, we were developing formulas, flow formulas. So we had this concept which was very useful, that we imagine a control box where the flow comes in from one end, goes on the other end. In this control box, the temperature can change. There could be radiation. There could be anything. It's like what the American economists they are doing. They're imagining that there is a control box around the United States. They're making all these models how things can go. But this concept that they use is totally flawed, because this control volume boundary has to be extended to very far and wide, in fact worldwide, because a lot of the stuff that we use here is really foreign labor. It's really very cheap foreign labor. Is the fruits that were grown in Mexico or Brazil, this oil that came from Venezuela, from Iran, from Saudi, that the cost of producing that oil here would be like $100 a barrel, but they're selling it to us like $60. We are experiencing very extreme deflation or cheap labor that's coming into this control box, and then also we are also looking at return on investment within this control box, which means that if I have cheap money, it will be lent out to these banks and to these guys, and they are all within this control volume. But that's not really true, because all the banks and all the corporations, they are very connected in the world, even far away places, and the rules, or what the economists like Peter Schiff or Stockman, they come out, these rules, they really were imagined for this control box, for this one country, which is totally bogus. So I think what's happening is there is two curves that are going to come and meet at the point. One is the extreme deflationary curve because of cheap labor, and later on it's going to be the robotics, the AI that can manufacture or do any kind of service or any kind of algorithms of motion, like a robot coming taking care of the patients. Well, that's the labor money that was there, was allocated for that job, that has collapsed to zero. So this is a very strong deflationary curve. Another curve, which is the inflationary curve, which is all the stupid things that the U.S. central bank is doing and other central banks, just outrageous printing of money and going on military ventures and fiscal irresponsibility. So these two curves, they had equalized at some point, and things were stable for a while. But as the folly increases, as the Americans keep publishing more money, this inflationary curve is going to come in and overtake this deflationary curve. So there will be a amount of inflation which exceeds the return on a 30-year bond, on a 10-year bond, on a 3-year bond. It would be like a Greece moment when the many fund managers, many holders of bonds, they discovered that they are losing money. Uh, they would they would sell all these bonds. Well, I don't know if you saw that Disney movie that there was this sorcerer and he had an apprentice, and this sorcerer could summon up seeds of liquidity. And anyhow, the sorcerer gets tired of playing with his waters and stuff and goes away, and the less experienced apprentice comes in and gets the staff and summons the seas and summons all the water, and then he creates this environment. There is so much liquidity, so much money slushing around, it kind of becomes a huge disaster for him because he cannot stop this slushing and destructive effect of a lot of water. Well, the U.S. government has been publishing money, has been, I don't know how much 30-year bonds they have outstanding out there, how much 10-year bonds. I know just some numbers from like the Chinese were holding 2 trillion or a trillion, Japanese so much, and foreign countries were holding a lot, but these days it's really a lot of the banks are holding toxic debt and toxic and siloed money. So when the gateway is open, when many of these institutions they discover that hey, we can do a lot better with this money than just loaning it to the U.S. government or loaning it to governments even, or because there is so much cheap labor and so much production or return on investment in the world, then the floodgates will open, and this is like a very hard slap from the market, which means that overnight the interest rate will spike 1 point, 2 point, can go anywhere, it can go 8 point, 10 point, and that would be the disastrous consequences of a long-term cheap money or long-term low interest rate. Because when the interest rate was low, then the corporations or the government could roll the bad debt they had into this new cheaper loan, and then this is like hiding a lot of mistakes and disasters in the past. Well, this could be the very healing for financial markets for many of these corporations or companies that are really zombie banks, zombie corporations, to go completely out of the market, they become completely bankrupt. Well, I had a video was called 2019 Psychic Predictions, and I predicted that this will be the year where really the world will prosper from American finance, and this is exactly what's happening or will be happening. Well, I was also listening to Gregory Mannarino, and he was saying that a lot of money is moving to the dollars. So what this means, when there is a lot of dollars in the market, there is a lot of liquidity, the value of the dollar is going to collapse. Well, some are saying that it will collapse to 50% of what it is now. But I don't think it will be that drastic, because these dollars will go to many countries that are very poor or very starved for capital to be invested there, and also follow the same trajectory as the goods that were made in foreign countries, and they should be really sold at a higher price. But there is a force of history of this product that was sold for 20 years for $10, and there is a resistance in consumers to buy it at $11. So this resistance and this cheap labor or products coming from foreign countries, this is what's going to kind of stabilize the markets, and the consumer goods might not spike in price as much as people think, but there will be a lot of carnage in the financial markets, and a lot of days of reckoning. Well, thank you very much for putting up with me, with my rant. Please subscribe and leave a comment. Thank you.